The Indian stock market is an expansive financial marketplace where shares of publicly held companies are traded. It's a crucial component of the Indian economy, facilitating the flow of funds, encouraging savings, and contributing to economic growth. Now, where does all this trading happen? There are two major players in the field: the Bombay Stock Exchange, fondly known as BSE, and the National Stock Exchange, or NSE for short. BSE, one of the oldest exchanges in Asia, and NSE, known for introducing electronic trading, together form the backbone of the Indian stock market. They serve as the platform for buyers and sellers to meet, negotiate, and trade shares. So, with that basic understanding, let's delve deeper into the fascinating world of the Indian stock market. Before we go further, it's important to know some basic stock market terms. Firstly, let's define what shares are. Shares, also known as stocks or equities, represent ownership in a company. When you buy shares, you become a part owner of that company. Next up, dividends. Dividends are a portion of a company's profits that are distributed to its shareholders. Think of dividends as your share of the company's earnings. Now, let's move on to IPO. An initial public offering, or IPO, is when a company first sells its shares to the public. This is a way for companies to raise capital and for investors to become part owners of the company. Sensex and Nifty are terms you'll frequently hear in the Indian stock market. They are index benchmarks that represent the performance of the top companies listed on the Bombay Stock Exchange and the National Stock Exchange, respectively. Bull market and bear market are terms that describe market trends. A bull market is characterized by rising share prices and general optimism about the economy. Conversely, a bear market is marked by falling share prices and a pessimistic outlook. Finally, let's talk about market capitalization, often shortened to market cap. This is the total value of a company's shares of stock. It's calculated by multiplying the company's share price by the total number of its outstanding shares. Large-cap companies are typically more stable, while small-cap companies may offer more growth potential but come with higher risk. And there you have it, a brief rundown of some common stock market terms. Remember, a solid understanding of these terms is the first step towards becoming a savvy investor. Now that you have a grasp of these basic terms, you're ready to dive into the mechanics of the stock market. So, how does this complex ecosystem of buyers, sellers, and companies work? Well, let's dive right in. The stock market operates much like an auction house. It's a place where buyers and sellers meet to trade investments. At the heart of this ecosystem are shares, which are essentially pieces of a company that you can own. When a company decides to sell parts of its ownership in the form of shares, this process is known as issuing stock. These shares are then bought and sold on the stock market. But you may wonder, how do these transactions happen? This is where stockbrokers come into the picture. These are licensed individuals or firms who execute buy and sell orders on behalf of investors for a fee or commission. Now imagine you're a prospective buyer. You've got your eye on a particular company's shares. You place an order through your broker, specifying the number of shares you wish to purchase and the maximum price you're willing to pay. This is known as a bid. On the other side of the transaction, there's a shareholder who's looking to sell. They specify the minimum price they're willing to accept for their shares, aka the ask price. When the bid and ask prices match, a trade is made, and ownership of the shares is transferred from the seller to the buyer. But what determines these prices? In a nutshell, supply and demand. If a company is seen as valuable with a bright future, more people will want to buy its shares. This increased demand with a fixed supply of shares drives up the price. Conversely, if a company is seen as struggling, demand for its shares may decrease, causing the price to drop. This continuous process of price discovery, driven by countless investors making their individual buying and selling decisions, is what keeps the stock market ticking day in and day out. That's the fundamental process, but how do you decide what stocks to buy or sell? Stay tuned, as that's exactly what we'll delve into next. To make informed decisions in the stock market, Investors use fundamental and technical analysis. Diving into the world of investing can be a bit overwhelming, especially with the myriad of terms and concepts one needs to understand. Two of the most critical concepts are fundamental and technical analysis. These two analyses are like the twin pillars of investing, each playing a unique role in helping investors make informed decisions. Let's start with fundamental analysis. Think of this as your deep dive into a company's financial health. It involves studying everything from a company's earnings reports, its position within the industry, the quality of its management, and even the state of the economy. It's like being a detective, sifting through the facts and figures to understand the company's true value. This approach helps investors determine if a stock is undervalued or overvalued, enabling them to make investment decisions based on intrinsic value. Now, let's switch gears and talk about technical analysis. If fundamental analysis is the detective, then technical analysis is the fortune teller. It involves studying price movements, trends, and patterns in the market data. It's all about charts, graphs, and indicators. The goal here is not to determine a company's intrinsic value, but to predict future price movements. This analysis is particularly popular among short-term traders and those involved in day trading. So, you have fundamental analysis, the detective, delving deep into a company's financials, and technical analysis, the fortune teller, predicting future price movements based on past and present data. Together, they provide a comprehensive view of a company's current status and potential future performance. However, it's essential to remember that while these analyses can provide valuable insights, they aren't foolproof. They aren't crystal balls that can predict the future with absolute certainty. The stock market is influenced by a multitude of factors, some predictable, others not so much. These analyses can help predict a stock's future performance, but are they enough to guarantee success? That's a question we'll dive into as we explore the importance of risk management in the next section. No matter how much you study and analyze, the stock market always carries some level of risk. Just as a skilled captain navigates stormy seas, an intelligent investor must be adept at steering through the volatile waves of the stock market. One of the most crucial skills for this journey is risk management. Risk management is not just a fancy term, it's the life jacket that keeps you afloat when the market's tide turns against you. So, why is risk management important in stock trading? Well, the stock market is unpredictable. Despite all the analyses and predictions, sometimes things don't go as planned. That's where risk management comes into play. It's your contingency plan, your defensive strategy against potential losses. Now, how do you manage risk? There are several strategies, and we'll discuss a few of them. First off, we have diversification. It's a strategy that involves spreading your investments across a variety of assets to reduce exposure to any single one. It's like not putting all your eggs in one basket. If one stock performs poorly, the others may make up for it. Next, we have stop-loss orders. This is an order placed with a broker to sell a security when it reaches a certain price. It's like setting a safety net beneath your investments. If a stock's price falls, the stop-loss order ensures it's sold before the losses become too great. Lastly, there's an age-old wisdom that still holds true. Don't invest more than you can afford to lose. Investing is not about betting your life savings on a single stock. It's about making calculated decisions and being prepared for any outcome. Risk management doesn't guarantee profits, but it does help minimize losses. It's about staying in the game, even when the going gets tough. It's about surviving today so you can thrive tomorrow. It's the difference between playing checkers and playing chess. In the stock market, you want to be the chess player, always thinking several steps ahead. Remember, smart investing is not just about making profits, but also about minimizing losses. So, that was a quick overview of how the Indian stock market works. We began our journey by understanding the basic terminologies. Stock, shares, dividends. These are no longer alien terms to you. We then delved into the mechanics of the stock market, revealing the intricate dance of supply and demand that drives prices. From there, we explored the realms of fundamental and technical analysis. You've now seen how these twin lenses provide vital insights into the health and trajectory of stocks. Remember, a well-rounded investor uses both to make informed decisions. And finally, we touched on the all-important subject of risk management. Understanding the potential risks and how to mitigate them is half the battle in investing. With this knowledge, you are now better equipped to start your journey in the Indian stock market. Happy investing!